Hi, I'm Peter Rose, founder of Longwood Currency Trading. The obvious Forex trading secret. What could that be? I'm in the kitchen again today. I've done the last series of videos because it's been really nice in here. And I enjoy just being out here in the, our house is a 1775 antique cape in the woods, as you can see. And I've lived in the city before. I really enjoy living in the woods, and for as long as we can maintain this property, we're going to stay out here and enjoy these changes of seasons. And right now, as you can see in the background, the trees we're in stick season. That's when all the leaves have fallen off in fall. We've gone through a beautiful autumn here in New Hampshire in the Lakes region, where people from all over the world come and watch the autumn colors, and then the fall comes and we get a nor'easter come in and drops all the leaves, and that leaves us with stick season. So it's a process. It's following from one season to the next. Trading is like that. You're moving from one phase of the life cycle of what I call the life cycle of a currency position, from entry analysis, position management, into exit methodology, rinse and repeat, and that's the trading process. But there's an obvious secret to trading, and I don't believe in secrets because that's why I call it the obvious Forex secret, because everybody's going to understand it. It's just that, do you understand how to implement it, and do you have the tools, have the skill to figure out how to change that from a losing trade to a winning trade, or losing process to a winning process. All right, enough of the travelogue. The obvious Forex trading secret. There's 6 bullet points here. The first one is, let's abstract back out to a large view of the Forex trading market. Why are there huge doji candles around economic news releases? And I'm not just talking about a non-farm payroll. We just had a consumer price index. There's had dojis. There was new housing starts, a good indicator and one of the major ones, but generally nothing that's going to create havoc. And yet doji candles. By huge doji candles, I mean dojis with massive candle bodies and wicks and tails. Why are there huge doji candles around economic news releases? Well, the obvious answer to that is the volatility. Well, there's a lot of volatility in the market. Oh, okay. So how do you trade that? Well, you don't trade just that, volatility. What causes the volatility? That's the question. What causes that volatility? You understand that 90% of retail traders are wrong, and they lose 90% of their money. Well, where does that 90% of the money go? Because Forex is a zero-sum game, and you have to understand that, because that's the key to understanding the secret here. 90% of retail traders lose 90% of their money. Where does that 90% of 90%, where did all that money go? It goes to the 10% of the retail traders who are good, who know what they're doing. So the secret in trading high volatility situations is to think like a retail trader, what they're going to do and why they're going to do it, and then do the opposite of that. Now you could say, that's the secret, by the way. Now you could say, well, that's contrarian thinking. No, it isn't. Because contrarian thinking is a very difficult seat to put yourself in as a retail trader. I'm not talking about bank traders. I'm talking about us as retail traders. It's very difficult for us to think about being a contrarian thinker because we're going against what everybody else is doing. And if everybody's running for the exits, you don't go the opposite way because there's a fire there or there's something wrong. So our DNA is geared up to go with the majority, because they have proved that the decisions that they make are correct. And so you look at the general Forex market, which is reflected in the price, and the price moves up. It moves up because everybody must be right. And then it moves down because everybody knows that it's going as high as it's going to go, and they all sell out. Yeah, but if they're selling, who are they selling to? So when you are in an economic release time, you know that 90% of the people are going to be wrong. So the obvious Forex trading secret is it's not dangerous to trade an economic news release if you understand the volatility. And since 90% of the traders don't and are going to lose, that's the secret. You have a 90% probability that you're going to get it right if you're a good trader during a huge volatility economic news release. But you have to have somebody who knows what they're doing working with you to show you the other rules that are involved in doing that. It's not quite as simple as the 6 little steps there. You have to have somebody that understands those rules, and then you also have to have enough general experience to be able to let go of your perception of what you think should be going on and look at what the crowd is doing and why they're doing it. And if they're doing it for the wrong reason, you will recognize that. You don't have to be a contrarian thinker. You just have to recognize, well, probably 90% of the traders are going to lose going both ways because they're following each other. They don't have a plan. They don't have a process. So if you have some experience in trading, the next time you get an economic news release come out, in the U.S., non-farm payroll is the big dog, or an interest rate decision, but you get these non-farm payrolls every month. You get producer price index, which is a bigger dog than the consumer price indexing. You got to go to the source of the things. So those are the really big ones. So watch those and see the dojis that occur and see where price ends up, and figure out for yourself how you might have recognized that thing if you want to trade the news releases. Yeah. Most of the time I don't trade them because they're not big enough to really create a violent enough reaction because you don't have 100% likelihood that you're going to make it. Even though you're 90% chance of getting it right in seeing what's happening, you might overestimate the magnitude of the reaction. And you have to look at past price action to see where prices, the level that price is built up at, where it's exploding out of, in order to judge what the price momentum will probably be. It takes some experience in trading. So if you're, less than 3 or 4 years of trading, why bother with it? Just don't trade around the economic news release periods. Don't trade an hour before and don't trade an hour after. Pick up the pieces afterwards. So that's like trying to get into the movie theater for your show while the other show is getting out. You're going to get trampled. So why bother? Just stand on the side and wait till it clears and then go in. But if you have enough experience, that will tell you when it's good to go in. And sometimes it's good to go in right in the middle of all that shit because that's where you make your money. But it's contrary to what the majority is doing. So you just have to change the way that you think in that particular instance. You can't think that way in the rest of your trading to that extent because you can get screwed up in the minor fluctuations. Minor fluctuations, 20, 30 pips. You get a 30 pipper wrong and you're really hurting. I talked about that in my last video. 30 pips is a big hit to take. And it's very easy to drop 30 pips if you get a like this in a economic news release that's not a major one, that doesn't establish a major trend condition, or not trend, but a economic news release period price action. You could easily lose 30 pips. You could easily lose 60 because you get 25 or 30 going the wrong way, and then you reverse it at the wrong time and you lose another 20, and you're in the deep woods real quick. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.